Hi everyone, I'm Steve Hoare of Gaming Intelligence and welcome to the very first Gaming Intelligence Analysts Hour. I'm here with three very distinguished betting and gaming analysts to talk about the GIQ20, our ranking of the fastest growing listed betting and gaming companies. We're going to talk about the financial results from 2020, who had a good year and who's set to go strong in 2021. But without further ado, let me introduce you to our analysts, Ivor Jones of Peel Hunt. You can say hello, Ivor.
Hello.
Gavin Kelleher of Goodbody.
Hello.
And John Decree of Union Gaming.
Hello.
Right, chaps. So I'm kind of using the GIQ20 as our guide for this conversation. It's our ranking of the world's fastest growing listed betting and gaming companies. For me, there's a very obvious theme that dominates, and that's the US market and its ongoing rollout of sports betting and gaming state by state. I'm sure we'll also talk about the pandemic as well, because obviously that has affected everyone's results, for better and for worse. So first off, so Rush Street tops the GIQ20, and we'll talk about them later because their 337% rise in revenue is pretty astonishing. But we'll come back to them. Let's talk about Flutter first. It largely owes its place at the top of the chart to the acquisition of Stars Group, but it seems to me that they've done very little wrong in recent years, at least since the somewhat tricky integration of Betfair when Paddy Power acquired it. Gavin, what's your take on Flutter's rise and rise?
Well, I think Steve, you've struck on it correctly. The Stars Group acquisition helped them massively last year in terms of the revenue growth they delivered. But even excluding the Stars deal, pro forma revenues for Flutter were still up 28% in 2020. So that underlines a very strong performance, considering that the group had over 4 billion of revenues. To grow that much off a big base is a really good outcome. I think they obviously benefited from the pandemic, and during Q2 they saw a huge benefit from poker. But you're totally correct in your summation that they haven't really done anything wrong in the last year in terms of operationally. All the main parts of the business are delivering double-digit growth. They're taking market share in all their key markets. And to top all that off, they're really developing the leading business in the US through FanDuel. So top marks for Flutter in 2020 and into 2021.
Yeah.
Do you think it's fair to say that they also benefited from finally catching up on the gaming side in Europe, where they've been a laggard and clearly a lot of investment and effort is paying off?
Yeah, definitely, Ivor. I think you can see in Sky Bet has always been doing well in gaming. They acquired that last year, that helped. But you could see in Paddy Power, they've really started to motor on the online gaming side. And as you say, they were a laggard for a number of years before that. And what better time to have a good gaming product in place than when a pandemic strikes and everyone's at home playing online gaming, or it saw a big boost last year. So timing is everything, and that really helped them as well, Ivor.
Do you see, there are possibly some clouds on the horizon. Do you make much of this Kentucky case? I don't know. John, are you plugged into the Kentucky case against Flutter?
Sure, yeah. So, look, I think we all knew what was going on in the Kentucky case. Flutter's most recent company announcement indicated they'll continue to fight, and they still believe that their liability is much less than the Kentucky Supreme Court. Ultimately, the courts will determine it, but it would be one time in nature, whatever the liability payment is. That's certainly not going to upset their growth trajectory or their ability to conduct business. It's a very well capitalized company. Whatever the outcome of the case is, it'll be sore, whatever the amount of the liability, but I don't think it's going to impact their fundamental operations. It's certainly not going to impact their ability to be a dominant player in the US. So it's been an overhang legacy from the Stars Group. I think everybody's been well aware of their managing the situation well. We'll see what happens in the court. I think they're going to take it all the way to the top. And from our perspective, the liability that the Kentucky Supreme Court is talking about is just way too much. So we'll see if they have success at the Supreme Court, and it's not going to impact their fundamentals all that much. It's obviously a large sum of money right now, but when we think about this business and the amount of revenue and cash flow that they can generate, it'll just be a hiccup, and they'll just continue to plow forward, I think.
Yeah, I mean, it does look like a huge amount of money at the moment. What is it? It was like 5 billion or something, wasn't it? But I guess
I think it could. I think it could be $1 billion with accumulated
Yeah.
interest, maybe order of magnitude.
That's
Yeah,
correct.
it's 870 plus 12% compound interest over 5 years, I think. So as Ivor said, I think it's 1.2 or 1.3 billion, but I don't know what the outcome is going to be, but I'd be pretty confident it's not going to be that high. And as John said, they'll end up paying a sizable amount of money, but it's going to be a drop in the ocean to Flutter, to be honest. We actually put in $200 million in our valuation for it, but I wouldn't be surprised if it was lower.
I'll offer a slightly different view, not about necessarily the conclusions for Flutter, but Flutter is not the only company that has inherited a history of unlawful, and I use the word carefully, activity in the UK. There was bwin Party and On Game, now part of Entain. There was Party Poker, part of Entain. There was 888. There's a whole string of companies that have a legacy of unlawful activity in the US prior to UAGA. Depending on where the Kentucky case goes, we could see other prosecutors come out of the woodwork, seeing a revenue opportunity for their state's coffers. So why bother starting the process now? Why not find out where Kentucky gets to with this? But I don't think there's zero risk of a knock-on.
The one thing I'd add that would give me comfort on that point, and I would agree with Ivor that if this rules if Flutter has to pay a big amount for Kentucky, you could see a knock-on effect. The only thing I would say about the Kentucky case is it's been ongoing for a number of years. They've been trying to do this. So with kind of statute of limitations, and I'm no legal expert on this, I'm not professing to be, but you'd think that it would be maybe difficult for other states to try and get their pound of flesh, if you like.
Yeah, but I noticed that if you think about legal structures in the sector, I think I'm right in saying that William Hill was careful what it bought from Sportingbet to buy operations rather than corporations.
Yeah,
language I'm struggling for, to make sure it sealed off some of that risk, and quite a lot, as you remember, remained in the Sportingbet business. So where you've bought a corporation, you can potentially inherit the legal risks with it if you weren't careful just to buy the IP and the customer list separately. So some people did think ahead to insulation from those risks, and others have decided to go ahead and buy corporates with the risk that comes with them.
I mean, let's talk about Entain, because it is, in size terms, it's the closest challenger to Flutter, but it's probably suffered this year more because it's got a much bigger retail exposure than Flutter. Would that be a fair summary?
I think you're right. You'd have to look at I think the online performance was as good as, or was towards the upper end of the pack, and the retail business inevitably dragged as a result of COVID-19. So I don't think you can see that as an operational weakness. It's just a function of its structure.
Yeah, totally agree with what Ivor said there. Like, I think if you look at online growth for Entain in the last year, it was similar to Flutter, was 28% online growth. And retail was obviously massively impacted by the pandemic, which saw overall revenues flat or down 1% in the year. I think from what investors are looking for, investors will take online revenue growth any day ahead of retail growth, given the kind of valuation impact it has. So, as Ivor said, Entain has had a very good year from a share price perspective in the last year. And I think if you had told us this time last year where Flutter's share price is today, 12 months later, I think myself or Ivor probably wouldn't have believed you. I think I'm speaking for you there, Ivor, but I don't think we saw it being as high as it is. But in fairness, like operationally, again, in online, Entain has excelled.
And do you think the departure of the CEO, Shai Segev, will impact things going forward?
I think as Jette has outlined, she has been involved with Entain since the end of 2019, sitting on its board. So she's not completely new to the Entain story, and she has been an insider, if you like, for the last kind of year and a half before she became CEO. I think as well, the strategy that was outlined in November last year, she was key in devising that strategy. So it's not really a massive evolution of strategy at Entain. There's not a major change.
John,
there's another issue as well around the departure of Shai, which is not operational, but from an investment point of view, environmental, social, and governance issues have rocketed to the fore, I think, of importance for investors. And I imagine that trend will continue to be the case. And I think Shy was clearly a digital gambling native. And whatever the company did, to some extent, that history would have stayed at that top level. Entain's doing an enormous amount on the ESG front, making sure it's eligible for membership of various indices, investing in charities, and really making a big point to investors about its ESG credentials. So if we're right, and that is increasingly of importance to investors, then I think that pivot to a fresh face at CEO is probably very helpful in that regard.
Were you surprised at how quickly Entain rejected the BetMGM bid? And do you expect BetMGM to come back again?
From my perspective, I think I was a little surprised to see how quick they had moved away. But as Gavin mentioned, in hindsight, it's top marks for them. They've been able to outline a pretty substantial growth strategy. I think MGM at the time was, really operating within the confines of expectations that they were trying to grapple hold of more than 50% ownership of the BetMGM JV. And as we kind of look across the map, MGM is a global brand. They have a big presence in Asia. They're pursuing Japan aggressively. They've talked for years about being a much larger digital company. And a lot of US investors looked at what Caesars is doing and trying to create a pure play on the nascent US market. I think MGM's ambitions are a little bit bigger than that. I think they've actually can truly appreciate the Entain business. They see it as a great avenue of international growth. And I think they need to articulate that a little better and figure out what the right price to pay for that opportunity is and get their shareholder base on board. But with someone like Barry Diller behind it, I think there's unlike other U.S. companies that are really honing in on the U.S. opportunity, I think MGM has ambitions for a global brand and a global international strategy. So I wouldn't be surprised to see them resurface for Entain with a little bit of a different story behind it. And that would obviously come with a little bit of a higher price tag, and see if they can find a way to put two great companies together.
How important is owning its own technology in the online and sports betting place?
In the U.S., right
Yeah.
now, it's been a trend that we've seen. We've obviously seen DraftKings early on spend a lot of money to vertically integrate. It's something that MGM really valued in their partnership with Entain. Bally's is one that went out and found BetWorks. And when we look at a new market like U.S. sports betting, there's going to be a lot of dollars spent in promotional and advertising and market share gains. So paying a supplier 5, 6, 7, 8% of revenue or whatever the going rate is going to be cuts into margin, and it's a perpetual expense. So I think there's a lot of opportunities to have proprietary technology. I think something like sports betting is people are going to have to find a way to differentiate themselves a little bit. A lot of the UK companies have significantly advanced technology. So I think it's going to be important in the long run. Right now, a lot of folks have plugged into Canby, a very easy white label solution to get up and running quick and start acquiring customers. But I think over the long haul, having that in-house technology and flexibility is going to be important.
Yeah. Let's
On that question, Steve, I think it's slightly difficult to tease apart the importance of the technology and the importance of the people, because you could stick me in a Mercedes and I still wouldn't win Formula One. You need Lewis Hamilton. And you don't see people just buying a bunch of code. You see people buying businesses, and the people who understand how to run the digital marketing, the people who understand how to run the risk management and the CRM. And I don't think I'm smart enough to be able to pull apart the importance of those two things. If you could buy the people that run a successful online sports betting business, could they operate the business for you using Canby as a third-party provider? I think they could probably do a pretty great job, actually. I think having absolute control of the development pathway of the technology is icing on the cake and a logical way to conclude the deal. But I think it's know-how as much as it's technology. It's
having expertise in-house, yeah. And on that front, it was very interesting with the Bally's acquisition of GameSys. I think that the first thing they announced was Lee Fenton, the super smooth CEO of Gamesys, being made potential CEO of the combined group. What do you make of that acquisition, Ivor?
The word that stood out in the limited press release we've had so far for me was omni-channel. So I think the deals we're talking about can be simply a low growth business buying a fast growth business and an opportunity to exploit opportunities in the US. I think there's a possibility 10 years down the road that the technology business that you buy becomes the common Rails platform that runs your land-based business and your online business, from the customer loyalty program, hotel reservation systems, and allowing people to play in a common environment in land-based and online. It's been talked about a lot, and it takes an enormous amount of investment. You need to eject other suppliers in the land-based supply chain so that you control the whole system. But I think that would be a logical progression to get towards, that you would, in the low growth environment, operate as much as your own technology as possible in retail in order to maximize your profitability. It would make sense of Entain and MGM as well. And so if that's right, then it would make sense that it be the Gamesys technology side that runs the whole business.
And I guess the obvious thing, I mean, whenever these things happen to me, my reaction is, oh my goodness, who's next? And you're always trying to sell 888, Ivor, and I'm a little bit surprised they haven't been snapped up. But that looks like the most obvious next acquisition target to me. Is that still the way you see it?
Well, not least because of the diminishing number of public market alternatives. So on the basis of probability, the chances must be going up. Although you're right, I have been predicting that for quite some time. I suppose on the basis of recent form, the most likely business to be bid for next is Gamesys. On the basis of the Bally's deal, I think is the third time that they've sold the same business. So I imagine the founder shareholders are going to be smart enough to find a fourth way of selling it. I don't know what you think, Gav, about next M&A.
Yeah, listen, I think there's obviously, I wouldn't say there's a rush to get proprietary technology and to get knowledge and know-how. And I think Ivor makes a lot of good points there in terms of the Mercedes example, I think, is excellent in terms of you can have the best technology, but you need people. So I think, to be honest, not to come out with a very bland answer, but really, I think everything is in play. Because this is a sector that, like, we've all covered it for quite a long time. And we often see deals that we would have never predicted, or the structure of these deals we wouldn't have predicted. So expect the unexpected. And it just feels like at the moment that I think anything could happen, and everything's in play. And you could see any form of merger, acquisitions as well. And everyone's focused on the US, but I think that's obviously where all the growth is. But there still is a lot of attractive markets outside the US, which have one difference. They're profitable at the moment. So I think you're going to see a lot more M&A because scale is important. And you saw it yesterday with Bet365 results. First time they had year-on-year decline in revenues, but they're still 2.7 billion of revenues. And between themselves, Flutter and Entain, they're significantly ahead of anyone else. So I think you're going to see more M&A, and it's going to be acquisitions. It's going to be mergers. People who just want to scale up, and that'll be in the US and outside the US as well. So there will be a lot more of it, but I don't know who.
You've got to look at the things that aren't in the press releases as well, which is some of this M&A is not about the strategic positives. It's about avoiding massive strategic negatives. So on the Gamesys side, one smart aspect of this deal is that in the next 12 months, there's a high likelihood that you wake up and discover a negative regulatory change in the UK core market for Gamesys, and a modest change, you wake up one morning and discover a large negative change in relation to Japan. And the timing and quantum are both unpredictable. If you dilute that with the core Bally's business, then you've just got greater diversity. So a lot of this M&A it's not the core bullet points in the press releases, but it's getting away from hostile regulation and tax increases.
Yeah. John, what's your feeling on the potential other US acquirers coming in?
Yeah, the one thing that the U.S. operators bring is market access in the way the regulations and patchwork framework of state by state with I'll use the word favoritism towards existing casinos, a lot of license tied to existing casino licenses. Online providers and technology companies have to find a partner with a U.S. entity, and there's a handful of companies that offer significant scale right away. Caesars, Penn National, MGM, Boyd Gaming. Bally's was next in line with access to 12 states and also cash flow, significant cash flow. As Gavin pointed out, there's other jurisdictions that are profitable. The US is not, but when you can leverage casino cash flows in the US, which are very cash generative and cash rich, that's a valuable thing to bring to the marriage of some of these companies. I think one that's been a little bit underestimated is Wynn Resorts. They're now have market access in 11 states. Most of those are via market access agreements, but that company generates in a normalized year substantial cash flow from Las Vegas through Macau, and they've clearly made a big push in the interactive business. And they've partnered with BetBull. They've got 70% control of that joint venture. But we watched Bally's roll up a bunch of technologies and small companies, Sports Caller, Monkey Knife Fight, which Daily Fantasy is something that's a great customer acquisition tool because it spans 40 some jurisdictions, and casinos are only in 23 or 24 right now. So I think Wynn Resorts is one that could probably be on the hunt for some additional technology and that know-how that we've talked about, those management personnel, those engineers that can really operate it. So that's one that's on my radar that hasn't gotten a lot of airtime.
Yeah, I mean, just going back to GameSys and 888, in terms of personnel that are operating, those two companies seem to be operating on a slightly different level to a lot of the people that are below them. What is it that you think distinguishes them, Gavin?
Which one, 888 or GameSys?
Well, both. I mean,
Okay.
I think they're at a similar level, and I think
Yep.
they're both quite similar in terms of the professionalism of their management team, long-standing experience of their management teams too.
Yeah, no, I think you've kind of covered it off there. I think both have excellent management teams. Now there is a distinguishing factor between the two of them. I would see 888 as more global, more diversified across regions and products, whereas Ivor touched on earlier on, and GameSys was very much focused on two markets, the UK and Japan. Whereas when you look at 888, the UK is 35% of revenues, and it's got diversification across a wide number of markets outside the UK. And the thing about 888 as well is it's got proprietary technology across all the main product verticals of sport, casino, bingo, poker. I think it's hard to find a company that has all of that 888 has, and it is a global operator. Yes, there's a scale gap between it and the likes of Bet365 and Flutter and Entain. But listen, I'd be definitely keeping an eye on 888 because I totally back the management team. I think they're growing very strongly organically. Huge growth last year in revenues, and I think they're in a perfect position to either do M&A or be involved in M&A some way or another, because they bring a lot to the table that no one else does.
Yeah.
The other unifying factor, Gav, is the focus on casino. So
True.
the money, the thing that is attracting a lot of very cheap money in the US is the sports betting opportunity.
Yeah.
And 888 is what, 72-3% casino. GameSys 68-69% casino brand revenue. Loyal customers, higher CPA, much higher lifetime value. And I think I think that having that to the fore and understanding the dynamics and the technology required for the most profitable product maybe is just structurally preferable to having a focus on sportsbook with casino as the cross-sell opportunity. If you're going to understand one thing really well, understand the casino part really well. And that feeds across the golden nugget too, doesn't it? Which is making exactly the same point. Look at us, look at our low valuation, making profit already in a highly profitable segment with lots of market share to mop up. Why would we want to be fighting for scraps in the sports betting market?
Yeah, and you're coming exactly to my next point, which was Golden Nugget Online Gaming and Rush Street Interactive. There was a interesting slide in Rush Street's investor presentation that was saying just that I think 76% of New Jersey is online casino compared to sports betting, and I think 72% of Pennsylvania or something is online casino compared to sports betting. They've got a similar DNA, those companies, I think. John, do you, on that front, we've seen very much FanDuel, DraftKings, and BetMGM kind of dominate the US market up until now, but Golden Nugget and Rush Street are doing something right, aren't they?
Absolutely. And I think Ivor just hit on it. It's the casino segment that is very profitable. Pennsylvania, New Jersey have proven that customer retention is a lot easier. The difficulty in the United States is we're only looking at a handful of states right now that offer iCasino. I think it's certainly just a matter of time before a lot more states jump in. I think as we get on the other side of the pandemic, people get comfortable with sports betting. It's regulators will, we've seen it so many times in the US. Gaming expansion just happens one step at a time, and iCasino is certainly next. And Golden Nugget Online Gaming, Rush Street Interactive have really pursued those high ROI opportunities. So while they don't have the big sports betting market share that the others have, they have very positive EBITDA and strong cash flow. And in the long haul, that's really where all the value is. So they also have really good presence regionally, and the US is rolling out regionally. So Golden Nugget is a brand that many people, everyone in New Jersey knows. In Illinois, Rush Street is a great brand. It's probably the best known casino brand in the Illinois market. And I think there's an opportunity for them to continue to grow on a regional scale and be very profitable, and over time compete. I think the others that you've mentioned, DraftKings, FanDuel, they've had a head start, and they have massive brands that they've invested in the US. So it's going to take some time for other companies to chase down sports betting market share. But I think Rush Street and Golden Nugget are okay, just really competing in that more profitable, higher ROI casino segment. And there isn't as much of a head start there because the regulation is a lot slower to roll out. So I think they're gonna be very good competitors, and see a lot more profitability much quicker than the others. I think that'll be a surprise to the upside for investors that are in the US looking for a little bit of a lower valuation entry point into what's going to be a really high cash flow business.
Yeah. One of the other things I wanted to mention, just in relation to Rush Street, really, was the growth in SPACs, and using SPACs and that form of M&A to list. There's been some contention about SPACs. Do you think that it's peaked now, or can we see? Do you think we can expect to see more deals, more SPAC deals, where gaming companies are bought and floated in that manner?
I think we'll see a few more. I think the height of the activity may have peaked. We saw the big headline trades. I think we'll see a few more. There's been SPACs that have money raised. There's a lot of small or medium-sized private companies across the US that really could use cash, and it's going to be easier to mold into a SPAC than to run a formal IPO process. It's quicker, and I think that's where SPACs really added value to private companies looking for capital. The market in the US is moving so quickly. Regulation has moved very quickly. The customer land grab, the market share land grab has started already. So it's a quick form of access to capital to get a couple $100 million infused into businesses to get on the map. And then we've seen the public comps rate up. Investors are willing to bid these companies up to market valuations, which will allow them to raise additional capital. So I think we'll see a few more, but I think the big splashy ones, the height of the activity is probably behind us for now.
Yeah. Okay. Cool. Right. I've got a couple of questions here that people have sent in to me. The first one is on William Hill. Now, Ivor, perhaps you're in a good position to talk about William Hill's future. The Caesars deal is closing, and we're expecting them to sell the digital part, the non-US digital part. But anyway, Ivor, what do you make of the Caesars William Hill situation?
So something I haven't seen before has happened, which is that the court meeting to approve the takeover by Caesars hasn't proven to be a rubber stamp. So a shareholder challenged the process. The court meeting was delayed by a day, and then the announcement on the 31st was that a judgment was expected in due course. So I'm going to take the view that's probably nothing, and it's going to go through as expected. But I'm more used to the court meeting happening on the day, and within half an hour seeing a press release announcing completion. So there's a possibility that we're sort of back to square one, and William Hill is off looking for another bidder. If it goes through, yeah, I think Caesars were clear that they didn't want to be the owner of the European businesses of William Hill, and so there are some attractive assets there to be bid for, and I'm sure they've had the better part of a year to work out the best way to maximise that value. If I had to guess, given the level of activity of private equity in this space, I would expect the online business to most likely have a private equity owner, and maybe the price of getting that deal done is taking on the retail in order to run it down, rather than leaving Caesars to split the retail away from the online piece.
Yeah, Gavin, do you follow William Hill?
Yeah, no, I do. The only thing I'd add, outside of those top three global operators, everyone wants to scale up, and William Hill, despite what people think about UK exposure, William Hill is the last way really to get significant UK sports betting exposure. So I think there'll be a long list of potential acquirers for those assets if and when they come up for sale.
It's an interesting business as well, though, isn't it? Because in recent years, since the acquisition of Mr. Green, that seemed to have become the engine for the digital side of the business.
Yeah, no, it has. I think that's a function of, I think everyone in the UK, if we had full clarity over what everyone's UK growth has been at different stages over the last 3 or 4 years, I think all major operators in the UK have, bar Sky Bet, really have gone through a period of, I think, getting rid of VIPs for their business, and they've seen a period of underperformance. That's hit William Hill probably more than anyone else, as they've cleaned up their business and made it more recreational. So even despite all those issues, I think William Hill still is a very good online business, a brilliant brand in the UK. Yes, you're correct, Mr. Green has become the growth driver of it, but I still think it's an attractive online business that people would love to add to its stable of assets, to be honest. So I think there will be a long list of potential acquirers for it if it does come up.
Yeah. Who else have we not covered yet? Playtech. We should talk about Playtech, shouldn't we?
Yeah.
Again, they're another one that's, after the acquisition of SNI, they're quite exposed to the retail, aren't they? Revenue's down 25% this year. And only just entering the US, but you would kind of expect, given their track record, for that to grow, wouldn't you?
Yeah, I think so. And I think what we've seen from Playtech is they obviously, as you've touched on in your question, they've been slow to show everybody their US optionality or how they're going to benefit from the US growth opportunity. But the one thing I would say is, if you piece things together over the last, let's say, 3 to 6 months, the US optionality of Playtech has improved massively. I think we've seen them get approval in Michigan earlier on this year. They obviously got approval in New Jersey last year, and they've signed a deal with Parks Greenwood, which could be a pretty significant deal for them over time. And then as well, only in the last week, on Monday this week, we've seen they've actually signed a long-term lease on a live facility in Michigan. And you would expect that they can get involved in live casino in New Jersey and Pennsylvania in time. So while revenues from the US are quite small for Playtech in 2020, I would not bet against them developing over the medium term a material business in the US, because every online market internationally, be it Asia, Europe, continental Europe, wherever it is, Latin America now, Playtech has always been involved, and they've always been a supplier of choice across many different verticals for people. So I think they will be heavily involved in the US in time, and they've definitely increased their US optionality massively over the last 6 months.
Would you concur?
And I think investors will give that more credibility if Playtech can make an online sport or a sports betting announcement in relation to the US. Because of what John said, there's obviously a bigger market for sports right now. So if Playtech could show a route to market in 20 plus states, then with sports, then I think that will make more investors pay attention to the US opportunity.
I totally agree. And sometimes I totally agree with you, Ivor. I think there's already been some, I'd say, early stage signs in sports. They've signed a deal with Novomatic to supply SSBTs. I think that's a positive step. And the deal with Greenwood includes Indiana, which is a sports state. So I believe in Indiana, Greenwood is going to be using the IMS of the platform, which is going to be for sports betting. So not directly a kind of a big sports betting supply deal, but they're already, I think, showing evidence that they can get involved in that market. But I totally agree with you, Ivor. If they do sign a big sports B2B client, I think that would really rubber stamp their US optionality.
John, what about the sort of the Playtech equivalents in the US, Cygames and IGT?
Yeah, they've tried to leverage their existing customers to get involved. And just prior to PASPA being overturned, Scientific Games made the big NYX Group acquisition to acquire the OpenBet platform, and they've been able to put some contract wins up. I think they were a little slower to the tape than we would have thought, not realizing how fast the industry would go, and people were looking for a much quicker plug and play solution. And I think they were a little slower to get going than we thought. So I know Scientific Games and IGT have existing relationships across all the casino companies, but they seem to have trailed a little bit from UK companies that just have maybe a lot more experience and a little bit more to offer on that stuff. So they're still working hard. Scientific Games still has a pretty good outlook, I think, but and they're looking to refocus. They've been stuck by quite a bit of leverage on the balance sheet. They're talking now about finding ways to unencumber the balance sheet and focus on some of the higher ROI opportunities like sports betting and iCasino. So they need to probably address their balance sheet first, and then they could perhaps make some more investment, more inroads into some of the US opportunities.
Yeah,
I think going back to what we said earlier, I think that OpenBet and Margin Maker are definitely not Mercedes. They're whatever a mid-range car is, and they don't come with a Lewis Hamilton. So I think that's probably part of the reason they're just not the partners of choice for people with big ambitions in the sports space.
IGT is an interesting one, I think, because their sports product is quite well respected, and I think I'm right in saying that FanDuel has used that for a speedy rollout around the place. But I believe that FanDuel or Flutter is now bringing it in-house. Is that right? Has anyone got some?
Yeah, FanDuel is in the process of going to a much more in-house proprietary model for sports betting, and really by the end of this year they'll have a lot of that done. So they did use IGT for the sports product at the start, actual certain parts of it, not all of it, but now they're moving a lot of it in-house in the US. And just the one thing on that, moving sports in-house is what everyone wants to do, but you can only do it if you have scale, and there's few operators that will have the scale to be able to do as much as the likes of Bet365 or FanDuel or Entain in-house. So there will be, I think there will be a lot of other operators that get involved in sports that will need more of a white label, or they'll need a lot more third-party sports services provision. So it's not a one-size-fits-all. So I think the IGTs, the Cygames and Playtechs, they'll definitely be parts of the market for them to pick up business from. But the one thing about sports is in the US, and it's already appearing that way, it's going to be very consolidated. So there may not be that much opportunity. So for third-party suppliers, it's going to be an opportunity, but nowhere near as big as the iGaming opportunity. Can I just add one? Can I just add one thing? Sorry, Ivor. If we look at the European market and the non-US market, there hasn't really been a massive success story in B2B sports provision. There's been success stories, but there's been nothing to the scale of Playtech or NetEnt or Evolution in terms of value creation. So the real opportunity, like underline it again, is all in iGaming, iCasino. There's opportunities in sports, but for B2B provision, but they're small in the context of what the iGaming opportunity is for software providers. That's just my view. I don't know if Ivor seconds that.
Software providers, I agree, but we should, they're not in my coverage, I don't think yours, Gav, we should talk about Sport Radar and Bet Genius, because I think they do have I don't know about the valuation, but I think they do have a very interesting exposure to that market segment. I know there's a debate about, what is the value of a non-exclusive right to data and to video feeds, but and risk management, but they seem to, between them, offer different but very interesting, valuable packages. And you cannot be running 12,000 live events on data that you aggregate yourself. You have to go to an aggregator who's already bought the rights. So, as often the case, some of the best businesses in the sector are owned by PE, and they come to the market later.
Yeah, definitely the sports data market is an opportunity, but I think those two probably have it sewn up already, Ivor, that
and IMG as well.
Yeah. So I'd agree, but again, haven't looked at the valuations of either anytime recently. I just wonder how big the data market will actually eventually be in the US. And if it is, the danger is that the more consolidated it becomes, the less pricing power they have against operators. So there's all sorts of different dynamics there. Personally, I think the best way of playing the US sports betting opportunity is by buying an operator, and that's FanDuel or Entain, in my opinion.
Cool, great. Thanks, gents. Is there anyone that we haven't covered that you kind of had in your mind that we should do or that we would talk about?
I don't know about companies, Steve. There is one thing the reason I was looking online for this. I saw news stories in the US ahead of UEFA in 2016 in relation to people in the US who'd suffered harm from online poker. And then we saw the law be imposed. Last Friday, there was a negative article, an opinion piece in the New York Times about gaming, touching on Bet365 in particular. And I just thought there was a really interesting thing in the UK from Nat Sen, which looked at 400,000 accounts held among the top online sports betting and online gaming companies, looking at the concentration of revenue. And 5% of online betting accounts generate 86% of betting revenue across a pretty representative sample of numbers. And 5% of the casino accounts generated 82% of revenue. So 5 to 85 as a ratio. And I'll be very interested to see what happens in relation to the US opportunity, because at the moment, the companies present, as the sector's always done, as a very big revenue number divided by a very big customer number equals an acceptable spend per head. If you work the algebra back through the numbers I've just said, and you look at the actual spend per head that's responsible for 85% of the revenue, it's a much bigger and less socially acceptable number. Whatever you think about freedom of choice for people. And so Gav and I have lived through the regulatory backlash in the UK in relation to the UK and Ireland over a long period. At some point, I guess we have to assume it comes in the US. Of course, I don't know when.
Yeah, I agree. The only thing I would say about that NatSen survey is from what I think it used figures from 2 years ago. And I think there's been, if you look at the small print, I think if you look at the change there's been in that 2 years, it's massive. And whenever I speak to 888 or Entain and talk about those sort of figures, they're like, no, look at it now. I think Entain's VIPs count for less than 5%. Sorry, did I say Entain? I meant 888's VIPs count for less than 5% of revenues now.
That would be an astonishing shift if that were true.
No, I think it is. I mean, I might be wrong, but
Well, it depends. It depends what you mean by VIP.
In the last 2 years.
I'd be surprised if there were any business that didn't have an 80-20 split of revenue to customers, and I would expect it to be more skewed than that.
I think. Sorry, Ivor.
No, go on.
No, I think you raised the point about. I think myself and Ivor and and Steve yourself, when you look at the UK sector and I suppose the scars everyone has of the last, let's say, 5 to 8 years. When myself and Ivor, if we think back to 2012, we looked at a set of accounts and we looked for, actives are up, ARPU is up. This is really, really good. Whereas now we want to see actives up, we want to see ARPU down almost. We don't want to see growth in ARPU. So it's taken a complete step change in how we look at these companies. And I suppose back into the whole ESG theme that's going on in the background, the sustainability of businesses. I suppose the question is, and it's something that we debate internally, I'm sure Ivor debates it as well, is when are we going to see are we going to see negativity from the media, from different stakeholders around the potential for problem gambling or harm in the US? I think it's very much gone from 2018, where you saw the governor of a state place a bet. It was very politically acceptable to be supporting the industry. I suppose the debate is whether it's a 1-year issue where this could raise its head, or it's a 5-year issue. So I don't know if that's what you're thinking, Ivor, because we're constantly debating it. Does this conversation start in the US now, or is it something that starts in 5 or 7 years' time?
John, don't you think the US has a very different attitude towards gambling? I mean, the big casinos are thought of as huge employers, and they have huge political clout.
I think so. I think it's going to take a long time before that negativity plagues the U.S., for lack of a better word. And right now, it's really the first time that there's been this significant mainstream acceptance. Companies like ESPN, big media companies doing partnerships with DraftKings, and it's a sports culture in the U.S. I think there's just a lot of social momentum and acceptance of it. Now, a long time from now, before negativity surfaces, I think it does factor into how quickly it takes for problem gambling to really become an issue. But right now, I mean, we're still rolling out, still getting started. So it feels a little premature to be talking about that. But whether it's 5, 7, 10 years, I think the attitude is pretty good. And with the sports halo, it's the first time. I mean, it's all over TV here in the U.S. People are starting to talk about it. So I think it's going to take quite a while for the tides to turn from this, really excited, enthusiastic social environment. A lot of state governments here in the U.S. who still consistently lean on the gambling industry for tax revenues. So I think we'll go through those iterations first, those slaps on the wrist of raising tax and culling regulations before we see any substantial negativity. But we're not even done opening up the market yet. I say the caveat to that is it does only take one big scandal or one big national or international public event that could jeopardize politicians' views. So I think if everyone continues to proceed thoughtfully and operate fairly, and there isn't a major issue that makes national headlines about problem gambling or sports integrity, I think we'll continue on a pretty strong growth path.
I think you make a very good point about one event, because I don't think we know what the level of problem gambling is in the UK, but we do know that half a dozen stories about people and their families who've had particular problems have been enough to completely change the colour of the debate, and that's the risk. I think a couple of op-ed pieces and a couple of unfortunate stories about people who've had a horrible time, and the tone changes quickly.
Could I add one thing? I totally agree with Ivor. I think the media drives a lot of political pressure, and I think political pressure then drives media pressure, and that's what I think happened in the UK. It's what happened in Australia. If you take the UK, let's say the UK regulated in the mid noughties, and then we went probably 2013, 2014 when the problem gambling argument started in the UK. So it was probably a 5 to 8 year process. If you look at Australia, it was probably you kind of look at the deregulation in 2009, it was probably 15, 16. So you can see it kind of, a very small sample size, but it definitely accelerated where it happened. It does take time to happen. The UK, let's say, took 8 years for it to happen. Australia, maybe 5, 6. That's the kind of figures we have in our head that I think it will happen in the US, but I think we're probably 5 or 6 years away from it yet.
Yeah. Chaps, Gavin, I know you've got to get off for your next meeting. So thank you very much. If you want to leave now, just leave and I'll say goodbye to the others.
No, I actually pushed that back to 3:30.
Oh, good man. I was getting worried for you. I was like, oh my God, we're going over. Thank you very much, John. Thank you very much, Ivor. Thank you very much, Gavin.
Thanks a million, guys.
Let's do
Good
it.
to talk to you all. Bye-bye.
Next quarter.
Take care.
Cheers. Bye, guys.
Cheers.
Thanks so much, everybody.